Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, June 6th, and then we'll see how things look for Wednesday, June 7th. We didn't see much of a move in the bigger indexes, the Dow, the S&P, the NASDAQ, or the NASDAQ 100. Where we saw a lot of strength on Tuesday was in the small caps and in the mid caps. And if we're really going to get set to go higher with the market, we need the smaller parts of the market to improve. And right now, it looks like that is happening. At the same time, on a short-term basis, we are still overbought as far as the S&P is concerned. We're bumping into overhead resistance. We may pull back. As we saw a few weeks ago, we may be able to consolidate by going sideways. We'll just have to see if that plays out, or if things really start to fall back, we'll keep evaluating the situation to see if it turns more negative. Before I get started, please know that I just posted a new supplemental video a couple of days ago. It talks about how you can protect yourself in the market. Sometimes we also call that hedging. I do have a PDF of the slides and charts that you can download if you're having trouble seeing the charts on the video. I have a private Facebook group that you're welcome to join. There is a poll that you're welcome to take part in on the community tab on the YouTube channel. And I also post these same videos on Rumble. For whatever reason, if you can't find me on YouTube, please go over to Rumble and here is the channel. All right, let's go back and talk about what happened. We did have a lower open and prices declined, but we never got down to S1 at 42.61. We rebounded from the low and we went back above the unchanged level and got back above the daily pivot at 42.80. As the day went on, we just chopped above and below the daily pivot. Also, the unchanged level, we went negative for a while, then went back positive. But we were able to get some strength back at the end of the day and close above the daily pivot. We were up 0.24%. Yesterday, we were down 0.2%. So not a big move so far this week. Volume continues to drop off. We're still below average, and that can be seen as a good thing. The market was going up on an increase of volume. Now that we're going down a little bit, up a little bit, but pretty much going sideways, to see a drop off in volume, that should be taken as positive. The technicals are still positive overall, but we're looking extended in the short term and somewhat in the intermediate term. Now the market is fixated on inflation and interest rates. What's going to happen next week at the Fed meeting? What are some comments that we can make? The SEC is suing Coinbase because they've been operating as an unregistered securities exchange, as well as not being a registered broker and a clearing agency. This really hit the crypto markets hard, but the last time I looked, Bitcoin, that's the one that I follow, was starting to bounce back up and then falling back down just a little bit more. 4,300 is still providing that overhead resistance. We need to be able to break through that. Small caps and mid caps, they really outperform in Tuesday's session. Discretionary also advanced while staples declined in Tuesday's session. On a short-term basis, we have everything that we've had before. The Stochc RSI, the Williams percent R, both CCI charts, the stochastics across the board now, the short-term boom indicator, and a new one is the CMB composite index. Those are all extreme positive. And when we see a whole long list like this, that typically means that we're overextended. Doesn't mean we're going to stop here, but it may mean that upside is limited for the short term. On the intermediate term basis, we're still pretty high with our standard deviations chart. The percent B is still extreme, as well as the Sean trend meter. The dollar was up and interest rates were virtually unchanged. We've seen that a couple of days in a row now with interest rates on the 10-year. We still have the yield curves that remain inverted that we keep watching. Sentiment is positive. One more tick and we'll go extreme positive. Right now we're at 74 where we had been at 73. Our trend is positive, but the green line is still coming down overall. The ADX is getting stronger. It's above its moving average, and now we're back above 20. So we are in an upward trend, but that upward trend is showing some 1 or 2 day weakness, and we'll have to see if things change from here. Our bias, I'm still keeping it mixed to positive because we've been chopping sideways, as well as with our momentum. The economic reports that came out, we didn't have any on Tuesday. There'll be more that come out on Wednesday. Looking at some Isabel Net blog charts, this is a chart that I showed yesterday. I was really disappointed when I went to watch the video and I couldn't see these numbers hardly at all. I tried to clear this up a little bit and see if this helps. But basically, they're just saying that now that we've gained 20% off of our lows back in October, good things tend to happen. And they've marked it with a green diamond over here. And looking forward, not so much in the 1 month, but when you go further out, 3 months, 6 month, and 12 month, the average return tends to be pretty solid, and we tend to be positive most of the time. Now, getting back to some of today's charts, this is our overbought, oversold composite. We're getting up to a reading of 81, usually at 80 or above. That's also looking extreme positive. Then here's another technical analysis chart, which is pretty similar to the charts that I show you, showing how we finally got above this 4,200 level. They're suggesting we could go all the way up to 45.80. We do have the previous high, and I've drawn a line on our chart showing that that may end up providing overhead resistance. This is really turning quite positive. Then we look at the Carson cycle composite for the S&P 500 coming into June and July, and you can look at other data that contradicts this. It says a proprietary composite of various cycles suggests strength into late July. We also have another chart that says mid-July. Other people are talking about how weak June can be. So take your pick. We just look at all the different information and then let our charts tell us what's happening. But that's this yellow area in here that we typically see some pretty good strength. Now, coming up in August and heading towards the latter part of summer, well, we'll just have to see how that plays out. We can only go with what we see right now. Then we're looking at the 10-year Treasury yield and comparing it to the copper-gold ratio. I usually cover the copper-gold ratio in the intermarket analysis video over the weekend, where that ratio has really been going down. As interest rates are going up, they tend to not get all that far apart from each other, and they tend to go in the same general direction. That's not happening right now. So are interest rates going to come down, or is copper going to start to outperform gold and help this ratio go back up? We looked at some futures yesterday. Here is the NASDAQ 100 futures positioning, showing that folks are getting a lot more bullish on the market. Then exposure to gold, starting to go back up a little bit, especially when compared to copper, where some people really jumped in as everybody was getting into gold. Then it started to fall back, so some people jumped out, but they're still seeing a net gain with those that are getting into gold. Then we look at the equity positioning. We're still just under the zero line, still a little bit more defensive. This is another way of looking at some of the negative divergences that we've been seeing, is that the percent of stocks that are outperforming the S&P, it's really dropped off in 2023 so far, where other times when we see really good solid upward moves, this line would be a lot higher. Then we're looking at cumulative global sector fund flows. As tech has been going up, that's the yellow line. People have been getting into that. As energy has rolled over and started to decline, a lot of folks are starting to get out of that. Keeping an eye on the Fed, since we're coming up to that meeting, there's an 80.6% chance that they will leave rates unchanged. Here's how we've changed over the last few days. The dark area is right now. Yesterday is this lighter blue area. A week ago is this smaller, lighter shaded area. And then where were we a month ago is this lightest blue shade. Getting into our charts and analysis, here's the intraday chart. We did have a lower open. We never made it down to S1 before going back above the unchanged level in the daily pivot. Then we came down to the daily pivot, above the daily pivot, under the daily pivot, went negative, bounced back up, came back down. Really choppy. But we saw some late day buying coming in, took us back above the unchanged level in the daily pivot to close above the daily pivot. Here's the 10-minute intraday chart of the SPY. We were drifting a little bit lower in the initial overnight session. We bounced up in the pre-market session, but we're pretty much going sideways. And right now, after the market closed, we're looking about where we ended so far for today. This chart is showing us a little bit of difference here, where value is now starting to outperform growth. They're both going up, but value is seeing a little bit more love right now, at least on a broad scale. Here's how they closed, with growth being down slightly where value was up. It also underperformed with the mid caps as well as the small caps, even though it was up over 3%. Here's our growth versus value chart, where we did see a decline in the overall ratio. And then looking at sentiment, our Ulster Index continues to be very low. The VIX is just dropping. We're down with the line chart and the bar chart. The VIX of the VIX continues to chop more or less sideways. The equity put-call ratio is also continuing to fall, even though we don't have a signal here that we're working off of. We have previous signals, but if we continue to go up, this ratio will continue to fall. Now, this is something that I posted in the Facebook group yesterday and also on Twitter. Are we seeing a change here? At the beginning of 2022, we rolled over and the equity put-call ratio kept going up and up and up and up and up as the market was really running into trouble. Now we're starting to roll over and come back down. We don't really know for sure if this is legitimate because we've rolled over a couple of times over the past year only to have it turn and go back up. But right now, this turn down is pretty positive. Then we were keeping an eye on the VIX to S&P 500 correlation. It's starting to come back down now. I just wanted to show you this chart. In case we continue to go down, I probably won't show this chart until the next time we see something interesting. This fear gauge is showing that we're dropping off, and the other fear gauge, a little hard to see, but it is also dropping off. We still are maintaining a risk-on posture with this ratio continuing to advance. Advanced decline line, we're still looking okay based on price. We're showing some improvement now based on volume, but we're not really seeing a breakout with the new highs. We did see some new ones, but our 5 period is still negative, even though it's trying to turn up. However, our 10 period still continues to decline. We're still above zero with the advanced decline ratio. That's positive. And we're above the advancing moving average with the accumulation distribution. That's positive. We're still seeing a longer-term negative divergence when we look at the NYSE advanced decline line and cumulative advanced decline line, but we did see a real improvement in Tuesday's session. We're also coming back above this trend line with the NYSE advanced decline line. That could be more positive. But longer term, we're still seeing a negative divergence between price and volume. Looking at the NYSE, we were able to get just barely above the moving average. We turned up slightly with the S&P. We're coming back up to the moving average with the mid caps as well as the small caps. Our trend, we are going positive now. The ADX is above 20 and advancing. It's above its moving average. But even though the green line's on top, you can see the last couple of days it has been coming down. Shorter term, we're seeing pretty much the same thing. We have a trend going on here, but the green line is declining. Volume continues to drop off. Looking at our short-term charts, here's the daily chart. We want to watch this level right up here, which is the August high. If we start to go back up, this may form some kind of overhead resistance. If we're overbought now and we start to go back up to this level, we'll become even more overbought, which may suggest that this resistance may really come into play. Now, if we fall from here, we'll come try this at another time. That's just something to be aware of for right now. On the bottom, you can see where we are continuing to be below average with volume. Showing you our 20, 50, and 200-day moving averages. We're showing some improvement on all of these charts, even though we're pretty much sideways with the 200. The Stochk RSI is still extreme, as well as the Williams percent are, the CCI 14, and the CCI 20. And our short-term stochastics is extreme, as well as the intermediate term, and now the long term as well. Our force index is not extreme positive and continues to decline slightly, but it's still positive overall. Some intermediate term charts. The balance of power is above the dashed line and advancing. That's positive. The go, no-go system has the darker blue bar. That's positive. The TTM squeeze is also more positive. And we're still up into this third standard deviation with this chart, suggesting that maybe we have gone up too far too fast. And these measurements haven't had a chance to really catch up. We're still going above the upper band on the Bollinger Bands. That could also suggest that we've screamed a little too high too fast. Our PPO study is still positive in the long and intermediate term. We're declining slightly in the short term, but we're still above zero. The Erin indicator rolling more or less sideways, but continues to be positive. We're above zero and advancing with our S&P 500 McClellan oscillator, and we're also above zero with the NYSE McClellan oscillator. The summation index is showing a little bit of improvement, but we're seeing a negative divergence based on price and volume. And then the S&P 500 summation index is turning back up, but is still below zero based on price. We have now crossed back above zero based on volume, but we're still showing an overall negative divergence here. The The Swenlin Trading Oscillator, improving and above zero based on price and volume. Our PMO steady. We are coming down just a little bit with the PMOs that are rising. We're showing some improvement with the buy signals, and we're turning back up with the PMOs that are above zero. Then looking at the PMO itself, where it is turning back up, we're crossing over positive based on price. We've already crossed over based on volume and showing some improvement. The Elder Impulse system for the S&P remains positive with a green bar. The dots are still underneath with the parabolic SAR. That's positive. The slope indicator continues to go up. That's positive, and the MACD continues to be positive. Looking at all of our oscillators, we are now turning up, especially in the longer-term oscillators with the TRIX and the KST. So we're positive across the board looking at this. The Sean trend meter is still kind of extreme positive here, even though it did decline slightly. We're above all the plotted moving averages in our moving average tree. We're back above 50 with the BPI, but we're still seeing this longer-term negative divergence. The NYSE BPI is still below 50, but it is showing some improvement. The Chaikin money flow continues to be positive, even though it declined slightly. The Chaikin oscillator, based more on price, that is showing some improvement. The money flow turned down just slightly, but continues to be positive. The ultimate oscillator is above 50 and advancing. That's positive. The vortex continues to be positive. On balance volume continues to look more positive. We're above the moving average. But longer term, we're still seeing this negative divergence, but it is showing some improvement when we look at the 200-day moving averages in the S&P 500 and then the 50-period moving averages also in the S&P 500. The Copic curve remains on a buy signal, as does the Pring bottom fisher. Here's the %B indicator showing that we're still looking a little extreme positive. RSI looking good with the 14, almost getting extreme with the 9 period. The boom indicator is still extreme positive on the 20 period moving average, seeing some improvement with the 50 and 200-day moving averages. Looking at our Fibonacci studies, we're still above this 4170 level. If we really start screaming down, we'll be watching to see if that will offer support. The short-term fib levels, if we keep going up and we get above 4,300, we still have this 100% retracement back to the August highs to deal with. Longer term, we also have 4313 above us if we keep going up. If we start to fall, we'll be looking at 4214 as a possible support level. We've gone outside of this parallel line with our downtrend channel, and we're still outside of this area. A lot of people thought we were going to bump up to this and fall back, and we did a couple of times, but now we've been able to break through and things are turning more positive. Our different charts, the Heiken Ashi is positive, the Kegi chart is positive, the Renko is positive, and the 3-line break is also positive. Our indexes, the equal weight did show some improvement, but continues to underperform the S&P. We're still seeing longer-term negative divergences between the Dow and the transports. We're showing a little bit of improvement with the utilities, but they're still lagging behind. The S&P to the equal weight index, we're seeing this come down a little bit because we saw a little more broad participation in Tuesday's session by some of the smaller stocks. The Dow was able to get back above its 50-period moving average. We came right down to that level. It acted as support, and we were able to bounce up off of that. The diamonds continue to be positive. The NASDAQ is still looking pretty good. We have this R1 level above current price. But when you look at the NASDAQ, the cumulative new highs minus the new lows continues to decline. However, if you look on the bottom, the new highs minus the new lows have now switched to positive. Looking at a fib chart of the NASDAQ, we're above this 50% retracement level currently. If we fall, will that level provide support? The NASDAQ 100 continues to also look pretty good. We do have some R1 resistance above current price. The Qs remain neutral. And then looking at the BPI for the NASDAQ, it actually turned down slightly. And we're above this 61.8% retracement level with the NASDAQ 100. If we fall, will that provide support? The small cap index, which really was up on Friday, was really down on Monday. Well, it was back to being really up again on Tuesday. We were able to bounce off this 50-period moving average and actually close above the 200-day moving average. But overall, the trend is still negative. We've seen a recent death cross. The Elder Impulse system for the small caps remains positive. And here's a look at the Russell 2000 small cap index. The RSI is showing a lot of improvement. and the MACD is still looking positive. The small caps to S&P 500 ratio did show some improvement, but still is in an overall downtrend. The small caps, we're seeing a little bit of a dropping off as this participation becomes a little broader. The small cap growth continues to outperform small cap value. The mid caps were able to get back above the 250 period moving averages. That is quite positive. The elder impulse system for the mid caps remains positive, and we're also seeing an overall tendency for growth to outperform value with the mid caps. Here's the robotics and AI ETF, which is doing really well these days. And when we compare it to the tech sector, it's finally starting to break out a little bit above the rainbow. Keeping an eye on the financial sector, it was up over 1%, but is still in a downtrend. The financials showing a little bit of a bounce, but continue to underperform the S&P 500. The regional banking ETF also bouncing a little bit, but is still in an overall downtrend when compared to the financial sector. Keeping an eye on bonds, not really a big change here with the 10-year. We were virtually unchanged based on the yield as well as the price. Then longer term, when we compare the S&P to the long-term bond ETF, we're still seeing the longer-term relationship not be as strong as it normally is. The shorter-term relationship is looking a little bit better, but the spread is really wide between the two. This is what we're looking for. We're wondering, is this some kind of a warning sign that we're being given right now? Then when we compare cash to further out interest rates, after we had been coming down, we're starting to go back up again. Some of this may be some uncertainty about what might happen next week with the Fed. The 3-month yield continues to break above where we were at right before the great financial crisis. Is this some kind of a warning sign that we're being given? On a positive side, the riskier bonds are starting to come outside of the rainbow when compared to the more conservative bonds. Our interest rate studies, here's the S&P to interest rates, where we're still pointing more towards a soft landing scenario. And the broad market is also showing improvement as well with shorter term bonds. And then the broad market to longer term bonds also showing some improvement. And the tech sector is really outperforming the 3 to 7 year bond ETF. Then just to give you an idea, if the economy was getting ready to fall off a cliff, would the home construction ETF be outperforming bonds as much as it is? Probably not. Growth continues to outperform value even though it ticked down slightly, and value is underperforming growth even though it ticked up slightly. Then looking at our long-term analysis, our special K chart, it's trying to turn back up. Can it get above this red line? That would be quite positive, but it hasn't done that yet. An update of our possible positive scenarios. We're above zero based on price and volume when we look at our 19-day exponential moving average of the advanced decline ratio. The Qs, even though they're coming down a little bit, are still outperforming the S&P. Saw a nice little bump up discretionary to the S&P and a little bit of a turn down with large cap growth versus large cap value. Then our other growth to value ratios. Large caps still strong overall, coming back down a little with the mid caps and showing a little bit of weakness now with the small caps. The ratio between the S&P 500 and the utilities continues to go up, which could give some really good support to the S&P. When we look at our broad range, we're seeing something that we haven't seen in a while now. We're just barely above zero when we look at the 5-day moving average of the highs minus the lows. That is more positive. But we see a little bit of weakness now when we compare S&P growth with value, where it has been coming down, but since the beginning of February, it had been going up quite strong. The 50-period new highs, new lows, still starting to come down overall, but our indicator is above zero. If it stays above zero, it'll have a tendency to turn that red line back up. 2-year Treasury yield, we're still wondering if we're getting some kind of a spike that we can work off of. We're not really sure about that yet. But this is positive, where the staples are really underperforming the S&P, and that ratio continues to fall. One thing to be aware of, as I usually point out right now, when we spiked and started coming down, the S&P had already had a nice little run up. We chopped sideways as this ratio was declining. If we really get set to go higher, we would want to see this ratio continue to fall. So what's our outlook for Wednesday? I think we're still dealing with earnings season. That's pretty much over, but there's probably a few companies here and there that will still report. The technicals are positive, but the negatives and negative divergences are showing some improvement. We have the weekly MBA mortgage applications index coming out, the trade balance, and consumer credit. Interesting things, but not really market moving in and of themselves. We just had the whole list of geopolitical events with the market really fixated on the Fed. Here is the economic calendar for the whole week, just showing the 3 reports that will be coming out. Just to look ahead a little bit, we won't be getting any economic reports on Friday. And then looking at the Stock Traders Almanac statistics for June 7th, we're pretty positive with the Dow, but we're more negative with the S&P and the NASDAQ. Then we're on the 5th trading day of the month, where we're seeing some initial strength at the beginning of June. Are things going to start to roll over? That's what this green pre-election line does before we start to get set to go into the rest of June, where we see more historical strength during this time, a little bit more of a decline at the latter part of June, and then finishing rather strong. Then this is Dan Bird's chart, where the NASDAQ tends to perform quite well until about the middle of July. Looking at our scenarios, can't go with the down one right now, but yes, we can still go with the up one because we are trending, even though we're overbought in the short term. So be aware of that. And we have significant overhead resistance at 4,300, and we're not going with the sideways trend for right now. So our warning signs, the S&P, new highs and new lows, they're not expanding, and they're actually still declining on a moving average basis. The bullish percent indexes are diverging, but it did cross above 50 and it's showing some improvement. There are lots of negative divergences and signs of weakness, but some of those are showing some improvement. The VIX is still showing that there's really no fear. The NASDAQ cumulative new highs, new lows are really underperforming the rise in the NASDAQ. The 3-month yield is above pre-Great Financial Crisis levels. Small and mid-cap indexes have generated recent death crosses. That's when you look at just the index. Earnings season, I think it's continuing, but it should be ending pretty quick. Positive side, we still have our seasonality and setups that are still in place and will be for the whole year. The Copic curve and the Pring bottom fisher are generating buy signals. The S&P remains above that downtrend channel upper line. That could be now support if we start to fall. We're still in a risk-on posture. Lower price levels may provide support. The S&P is outperforming utilities. That could be quite positive. The NASDAQ 100 and NASDAQ continue to break out. And the staples to S&P 500 ratio is declining, as well as the small and mid-cap growth is still showing strength, even though it is starting to turn back a little bit. So our conclusion, the S&P, it's positive now, and we are trending. And the numerous negatives and divergences are showing some improvement. But in the short term, we're overbought. In the intermediate term, we're slightly overbought. We're still positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.